Things are getting a little bit weird in Canadian real estate with a couple of changes coming to the banking industry and the way that money is lent. Welcome back to my YouTube channel. My name is Daniel Foch. I'm a real estate broker and analyst working in the Greater Toronto Area, and I try and cover the topics of real estate investment coast to coast for Canadian listeners. I appreciate you tuning in. Please like, subscribe, and leave me a comment if you haven't already. I love to have in-depth conversations in the comments. It's where I get ideas for content and understand what the audience wants to hear from me. So let's start by looking at who is OSFI, or the Office of the Superintendent of Financial Institutions. OSFI regulates any financially significant institutions in Canada. This includes banks, financial institutions, pension plans, and insurance companies. Basically, anywhere that consumers store their money for future use and it's being invested, especially with leverage, they make sure that these institutions are behaving in a sound financial fashion. Now, you're probably wondering, how does this relate to real estate at all? And here's the answer to the question. The purchase of real estate is based on leverage in most cases. The majority of cases, people are buying real estate with 20% down payment, which means that 80% of their purchase price is coming from credit or debt, and they borrow that from banks. A couple of headlines came out recently towards the end of the month of June. First one that came across my desk was that RBC faces pressure to bolster capital after the banking watchdog hikes buffer. The next headline stated that CIBC is under the banking regulators' remediation orders to fix some mortgage underwriting lapses. So this didn't surprise anybody in the real estate industry, because a lot of us know that CIBC is exceptionally good at getting deals done for their customers, especially at a branch level. It is especially interesting because some people would argue that CIBC is actually more strict than some of the other lenders. So the question becomes, what do the other 5 big banks look like? Basically, what was happening is if you went to go get a mortgage and you already had a home equity line of credit on another property, and maybe you were borrowing those funds to go buy this new property, and it was an investment property, CIBC would say, okay, you got to close that, and then we'll let you have this mortgage. But then they wouldn't verify that you had actually closed the home equity line of credit. And so they were actually lending you more money than they were allowed to lend you based on the capital requirements that are set out in the Bank Act and Basel III requirements and regulated by OSFI, the Office of the Superintendent of Financial Institutions. And so now, years later, after thousands of iterations apparently of this happening, OSFI said, hey, this is a problem. You've given people too much leverage and you have to stop. And the question becomes, how do they get people to delever without causing financial stress on households? Now, all of a sudden, this person has a HELOC and they've also purchased an investment property, and the market's been volatile and interest rates have been volatile. And they can't just force that person to pay off the HELOC. I mean, they can technically. HELOCs are typically structured as what's called a demand loan, which means that they can literally ask you to pay it on demand. If they do that, it's probably going to break something in that person's financial picture. And if you do that at scale, over thousands of different financial pictures, because this article literally says that there were thousands of iterations of this and the millions and millions of dollars of total volume, that creates a bit of a problem. Later in the day, after this article comes out, another article comes out that OSFI raised their capital requirement for the big 6 banks to 3.5%. It was previously at 3%, and now at 3.5%, we're actually double what the capital requirement was in 2019, when the market was pretty strong. Basically, what this means is that banks now have to hold 3.5% of the total money that they have out in the economy. They have to have that as cash on their books, so in the bank, as deposits or other type of asset. Here's where this kind of starts to impact the real estate industry a little bit more. In order to do that, in order for banks to get money back out of the economy, back out of borrowers, back out of consumers, they need to provide a good rate of return to incentivize people to put money into savings. In order to do that, they need to increase the rate on a GIC, as an example. And GIC is often the product that they're using to collect capital. And if they're giving you, let's say, 5%, they have that capital and then they go lend out at a mortgage rate that's typically higher. And the spread, the difference between the rate that they're giving you as a depositor and that they're charging you as a borrower is different, and that's where the banks make money. This could have an impact on fixed interest rates going up as banks try and make products more compelling for people to save money. You might be asking the question, why is this happening now of all times? You're starting to hear more and more about financial stress, people hitting trigger rates, et cetera, et cetera. Well, the answer to the question, and Peter Routledge, who is the director at OSFI, says this in the press releases, is that they actually feel that the economy is strong right now. And on paper, it is. The Bank of Canada feels the same way. That's why they're continuing to increase interest rates. And so OSFI wants to use this period of strength to start demanding more of the banks while they can still afford to feel that pressure that OSFI is applying to them, because it is a big increase in the amount of money that they need to keep. This is a little bit scary from my perspective, and it's a little bit foreshadowing from my perspective, because it means that he doesn't believe that he would be able to make this kind of move in 6 months' time. And, a lot of us are anticipating a recession, and it sounds like most of the powers that be are also of that market opinion. I think that this is generally a good move at the right time. I would have preferred to see them do this earlier, but the reality is they're doing this in a proactive way to try and create some resiliency of the banking system against any future downturns that we're likely to see in the economy. And the fact that they're doing it right now tells me that they also see a downturn in the economy, because they would be unable to make a requirement like this in 6 months' time. So combining a couple of these factors, the direct interaction of OSFI with CIBC, as well as the broader interaction of OSFI with all of the banks, tells me that the system is working and it's trying its best to create a safe and resilient banking economy in Canada. Thank you for joining me again. I really appreciate your support. I'm curious to get your thoughts on OSFI and what they're doing right now. Do you think this was the right move or the wrong move? My personal take is I think that this is generally a good thing, but if it requires banks to increase their rates to get more savings out of the economy, it could end up costing the consumer more. And I'm not sure how much more stress, financial stress, the consumer can take. But I'd love to hear your thoughts and whether or not you think this was the right move from OSFI, and what impacts you think this could have on the Canadian economy and on the Canadian real estate market over the next 6 to 12 months. So without further ado, please subscribe to the channel and leave me a comment and like this video, and I'll see you next time.